Good evening, and welcome to today's market briefing. Let's start with a look at Wall Street from last Friday. The three major indices closed virtually flat, with the Nasdaq at 26,517, the S&P 500 at 7,500, and the Dow at 51,564, all showing 0% change. This suggests the market was in a wait-and-see mode heading into the weekend. However, there were some interesting signals at the individual stock level. Nvidia rose over 2% to close at $210, and the Nasdaq 100 ETF gained 1.4%, indicating some late-day capital rotation back into tech names. But on the flip side, the Bitcoin spot ETF fell 2.4%, and MicroStrategy dropped more than 5%, while Bitcoin itself only gained less than 1%. Digital currency-related assets saw independent selling pressure, and this divergence is something we need to watch closely. Now let's turn to the global macro environment. The 10-year U.S. Treasury yield held steady at 4.45%, stabilizing after a sharp drop last week. But over the weekend, North Korea test launched an ICBM, and U.S.-China trade sanctions escalated further. The U.S. expanded its entity list, and China announced tariffs on soybeans, pork, and aircraft starting July 1st. With these developments, we expect safe haven buying to push the yield down toward the 4.30 level at Monday's open. If the yield breaks below 4.20, that would confirm a medium-term downtrend in interest rates, which is positive for growth stock valuation expansion. The VIX, our fear gauge, closed at 16.78, near the upper end of its normal range of 15 to 25. Given the three major geopolitical events over the weekend, the VIX futures are likely to jump into the 22 to 25 range on Monday, approaching the panic threshold. If the VIX opens above 25 and holds, the market would officially enter panic mode, and all risk assets could face systematic deleveraging. The US dollar index continued to weaken, sitting around 100.76, near its lowest level since early 2025. A weak dollar typically supports emerging market assets, but the current risk-off sentiment could trigger a short-term bounce. If the dollar index quickly rebounds above 101.5, that would interrupt the flow of capital into emerging markets. In commodities, WTI crude oil closed at $76.54. A pipeline explosion in Nigeria directly impacted supply, and when combined with the North Korean missile event, it raises the geopolitical risk premium. We expect oil to gap higher on Monday, testing the $80 level. Gold is already at historic highs, closing at $4,172.90. Safe haven demand, a weak dollar, and declining real interest rates are all supporting gold. The weekend events should push prices toward the $4,250 to $4,300 range. To summarize, the global market is currently in a risk-off transition window. However, if VIX futures do not gap up on Monday morning and U.S. equity futures fall less than 0.5%, the risk-off sentiment could be invalidated, and the market would remain in a high-level consolidation. Turning to China and the external environment for Chinese assets. The onshore and offshore renminbi are both stable around 6.76 to 6.78, near their strongest levels in a year, supported by a weak dollar. But the escalating tariff confrontation between the US and China could weaken trade surplus expectations over the medium term, putting depreciation pressure on the yuan. If offshore CNH weakens past 6.85, that would be a warning signal. A strong yuan combined with a weak dollar is theoretically favorable for attracting northbound capital flows into a shares. However, the weekend geopolitical events may dampen risk appetite, so the probability of net foreign inflows today is neutral to weak. On trade and tech friction, we have three confirmed developments over the weekend. The U.S. Commerce Department added more Chinese entities to its export control list. China announced tariffs on selected U.S. goods starting July 1st. And the European Commission proposed stricter export licensing for advanced semiconductor manufacturing equipment. These three layers of control are escalating simultaneously, putting systematic pressure on China's semiconductor supply chain. Based on this, we expect the shares to open lower today. But if the Shanghai 50 index opens with a decline of less than 0.3%, it would suggest the market has already priced in the geopolitical risks, and we could see a rebound during the session. For the A-share market specifically, the Shanghai Composite is likely to open lower and trade in a range of 4,020 to 4,080 points. The Chi-Next index, despite rallying over 2% on Friday, faces the most pressure today due to the direct impact of tech control escalation. We expect a decline of 1 to 2%. If Chi-Next opens with a drop of less than 0.5%, it would mean the tech sector has already priced in the negative news and is stronger than expected. For sector focus, energy and gold are the key themes today. The Nigeria supply disruption combined with North Korea geopolitical risk creates a hard supply-side shock for crude oil. Safe haven demand and a weak dollar continue to support gold. The energy sector could be the only sector to post positive returns today. The sector to avoid is semiconductors and the entire chip supply chain. Dual controls from the US and Europe, plus the entity list, directly hit the domestic substitution narrative. On top of that, semiconductor heavyweights on Chi-Next already surged on Friday, so profit-taking combined with negative news will create the heaviest selling pressure today. We also recommend avoiding consumer electronics and export-oriented manufacturing, as China's tariff countermeasure cycle has begun. Northbound capital is more likely to see net outflows today. Foreign investors, facing offshore risk aversion and tech control escalation, tend to reduce holdings in sectors like semiconductors where they have concentrated positions. If northbound net selling exceeds 20 billion yuan in the first 30 minutes of trading, that would confirm the outflow trend. On individual stocks, we have a few names to watch. Wolfspeed, or Wolf, is expected to trade with a slight upward bias. Silicon carbide substrates are a critical bottleneck for AI data center power supplies and electric vehicle inverters, and Wolfspeed as the leader benefits from surging orders. If the stock holds above last Friday's low, it could be a safe entry point, but do not chase the price. Core, or COHR, is expected to be relatively resilient. Its high-speed lasers are core to AI data center optical interconnects. If the stock pulls back today due to the broader semiconductor sell-off, it could be a buying opportunity. But if it breaks below its 200-day moving average, caution is warranted. For risk avoidance, AXTI is facing dominant downside risk. The stock has weak momentum, high China exposure, and elevated valuation. Today's systemic sell-off in semiconductors will amplify its decline. We recommend exiting positions. To wrap up with our core call for today, the dual shock of geopolitics and trade controls sets a risk-off tone for the open. Energy and gold serve as safe havens, while the semiconductor sector faces broad pressure. Our probability assessment for today is 20% for an up day, 45% for a sideways day, and 35% for a down day. Thank you for watching, and we'll be back with more updates throughout the session.